December 26, 2025. Silver closes at $78.11 per ounce, an all-time record high. We're witnessing something that hasn't happened in 46 years. Silver just posted its biggest annual gain since 1979, 169%, in a single year. While everyone was distracted by artificial intelligence stocks, political drama, and cryptocurrency speculation, silver quietly delivered the kind of returns that venture capitalists dream about. Gold hit $4,530 per ounce, also a record, up 73% for the year. Platinum surged 172%. Palladium jumped 124%. The entire precious metals complex exploded, and if you're like most people, you completely missed it. But here's the thing. This isn't a story about what already happened. This is about what's coming next. Because if you think a 169% gain is dramatic, wait until you see what happens when the COMEX runs out of silver entirely. And based on current delivery rates, that's about 4 to 6 months away. Here's what you need to understand. If you're watching this thinking you missed it, thinking the move is over, thinking silver at $78 is expensive, you're making the same mistake most people made at $30. Because this isn't a speculative bubble. This is a structural supply crisis playing out in real time. And we're not at the end. We're in the middle. Let me show you why. January 1st, 2025. Silver opens the year at $29 per ounce. Gold is at $2,620. The gold-silver ratio, the number of silver ounces it takes to buy 1 ounce of gold, sits at 90 to 1. That's an extreme historical disconnect. The long-term average is 60 to 1. The ratio had been stretched for years, with silver dramatically undervalued relative to gold. Then, something started happening in the data that almost nobody noticed. The COMEX, the commodities exchange where silver futures trade, publishes weekly inventory reports. These reports break down silver holdings into 2 categories. Registered inventory, which is available for immediate delivery against futures contracts, and eligible inventory, which is in COMEX-approved vaults, but not available for delivery. In January 2025, COMEX registered inventory stood at 32 million ounces. By June, it had dropped to 26 million. By December, 19 million. During a year when silver prices nearly tripled, the amount of deliverable silver in the world's largest silver exchange dropped by 40%. Think about that. In a normal market, when prices go up, supply increases. Sellers come out of the woodwork. Inventory builds. But in the silver market, the opposite happened. Prices exploded and inventory vanished. This wasn't random. This was mathematical inevitability playing out. And one institution saw it coming before everyone else. Between January and June of 2025, J.P. Morgan Chase did something extraordinary. For 15 years, they had been the most aggressive manipulator of silver prices. They inherited a massive short position when they acquired Bear Stearns in 2008. Instead of closing it, they weaponized it. They used a technique called spoofing to suppress prices, trigger stop losses, and maintain control of the market. In 2020, the Department of Justice convicted them of running a criminal enterprise. They paid $920 million in fines. 3 of their traders went to prison. In early 2025, something changed. According to multiple industry sources, leaked inventory reports, and analysis of trading patterns, J.P. Morgan appears to have stopped suppressing prices and started accumulating physical silver. Aggressively. The exact size of their position is not publicly confirmed, but estimates from precious metals, analysts, and industry insiders range from 650 million to 800 million ounces of physical metal. The most commonly cited figure is 750 million ounces. If these industry estimates are accurate, and if their average entry price was around $30 to $35 per ounce during the accumulation phase, the position would have required roughly $22 to $26 billion in capital. At current prices around $78 per ounce, such a position would be worth approximately $58 billion, representing a potential profit of $32 to $36 billion in less than a year. If true, this would represent one of the largest profitable trades in commodity market history. But JP Morgan didn't stop there. In November 2025, they announced they were relocating their entire precious metals trading desk from New York to Singapore, not opening a satellite office. Relocating. The managing directors, the senior traders, the people who make decisions. Everyone moved to Singapore. Why Singapore? Because Singapore has the most sophisticated precious metals storage infrastructure outside of London and New York. The Singapore Freeport operates beyond the jurisdiction of Western regulators. Metal stored there can't be requisitioned to settle COMEX contracts. It's beyond the reach of U.S. courts for most practical purposes. JP Morgan moved to Singapore because they know what's coming. They positioned themselves on the right side of the greatest supply squeeze in modern commodity markets. And then they moved their operation beyond the reach of the exchange that's about to fail to deliver on its obligations. In early 2025, when silver was $29 and everyone thought it was overvalued, they were accumulating. While retail investors were chasing artificial intelligence stocks and cryptocurrencies, JP Morgan was quietly building the largest private stockpile of physical silver on Earth. By June, silver had climbed to $35, the first breakout. COMEX registered inventory was dropping faster than it should. The Shanghai premium, the difference between silver prices in China and prices on the COMEX, was widening from $3 to $6 to $8. Dealer premiums on physical products were starting to climb. Silver eagles that normally sold for $2 to $3 over spot were suddenly commanding $5 to $6 premiums. September brought acceleration. Silver pushed through $45. The gold-silver ratio started collapsing. From 90 to 1 in January, it dropped to 75 to 1 by September. November is when it went parabolic. Silver blew through $60, then $65, then $70. The moves were violent, $5 swings in a single day. By Thanksgiving, silver was trading above $70 for the first time in history. The gold-silver ratio had collapsed to 62 to 1, and then came the final push. December 23rd, silver crossed $75. December 26th, $78.11, a record that stood for exactly 1 day before it was broken again. The gold-silver ratio hit 58 to 1. Silver had compressed the valuation gap by 35% in a single year. So what drove this? Why did silver outperform gold by nearly 100%? Why did it go up 169%, while the S&P 500 went up 18%, and even high-flying Nvidia only managed 42%? The only explanation for that divergence is supply and demand fundamentals specific to silver. And when you dig into those fundamentals, you find a crisis that's been building for years and finally reached a breaking point in 2025. Start with supply. Global silver mine production in 2025 was roughly 830 million ounces. That's barely higher than 2024. Why didn't production increase when prices went up? Because most silver doesn't come from dedicated silver mines. It comes as a byproduct of copper, zinc, and lead mining. About 70% of silver production is byproduct. This means silver supply is largely inelastic. It doesn't respond to silver prices. It responds to copper and zinc prices. Opening a new primary silver mine, where silver is the main product, take 7 to 10 years from discovery to production. Even with silver at $78, most new silver projects aren't economically viable as standalone operations. You need silver well above $100 sustained for years before companies will commit capital to new primary silver mines. So supply can't respond quickly. Now look at demand. According to preliminary industry estimates from organizations that track precious metals markets, industrial demand for silver in 2025 was running at approximately 900 to 950 million ounces. This represents an increase of roughly 10 to 12% compared to 2024 levels. Compare this to supply. Global silver mine production in 2020 was estimated at approximately 820 to 840 million ounces. The implication is a structural deficit in the range of 100 to 130 million ounces between newly mined supply and industrial consumption. Where does that deficit silver come from? Above-ground inventory, stockpiles. Silver that was previously mined and refined, sitting in vaults and warehouses around the world. This explains why exchange inventories have been declining. Industrial users are consuming silver faster than mines can produce it, requiring drawdowns from buffer stock. And that buffer stock is finite. When it runs out, when there's no more inventory to draw down, what happens? Either industrial production stops, or prices go high enough to force demand destruction. But here's the problem. For most industrial applications, demand is inelastic. It can't be destroyed at any reasonable price. Take solar panels. A typical solar panel needs approximately 20 grams of silver, according to industry data. At $30 per ounce, that's roughly $21 worth of silver per panel. The panel sells for $400. Silver represents about 5% of the total cost. If silver rises to $150 per ounce, that's approximately $105 worth of silver per panel, still only about 26% of the total cost. Does the solar manufacturer stop making panels? Historical evidence suggests no. They typically pass the cost to the customer. The panel sells for $485 instead of $400, and customers continue purchasing because solar remains cost-effective compared to grid electricity over its lifetime. Similar economics apply to electric vehicles. Industry analysts estimate that advanced solid-state batteries could require anywhere from 300 grams to 1 kilogram of silver per battery pack, depending on size, configuration, and specific manufacturer designs. Using a conservative mid-range estimate of 500 grams, that's approximately 16 ounces. At $30 per ounce, that represents $480 worth of silver. At $150 per ounce, it would be $2,400. For a $50,000 luxury electric vehicle, that's an additional $2,000 in materials cost. Electronics, smartphones, medical devices. All of these applications use small amounts of silver that represent a tiny fraction of total product cost. Even if silver quintuples in price, manufacturers will keep using it because there's no viable substitute. Copper corrodes. Aluminum doesn't have the right electrical properties. For high-performance applications where reliability matters, silver is irreplaceable. This is the trap that everyone missed. Industries spent 40 years building dependencies on cheap silver. They designed their products around it. They built supply chains around it. And now they're locked in. They can't substitute. They can't redesign their products overnight. They have to keep buying silver no matter what it costs. This is why industrial demand went up 12%, even as prices tripled. The solar manufacturers didn't slow down. The EV companies didn't pause production. The smartphone makers didn't switch to alternative materials. They paid the higher prices and kept producing. Because the cost of stopping is higher than the cost of paying up. Now let's add the geopolitical dimension. On January 1, 2026, China implemented a new export licensing framework for silver. Ministry of Commerce Announcement Number 68 stated that all silver exports from China now require government-issued export licenses. Why does this create uncertainty? Because China refines approximately 60% of the world's silver. Not 60% of Chinese mined silver, but 60% of all silver globally. Ore gets mined in Mexico, Peru, Australia, and other countries. It gets shipped to China for refining because China has built the infrastructure, developed the expertise, and achieved economies of scale. The refined silver then typically gets exported to wherever it's needed. The export licensing system gives China a control mechanism. They can prioritize domestic allocation if needed. They can slow approvals during trade disputes. They can ensure their solar panel manufacturers and electric vehicle producers have guaranteed supply. The system creates uncertainty for Western buyers who previously relied on Chinese refining capacity. Western buyers who depended on Chinese refined silver are reportedly experiencing delays or seeking partial shipments through alternative channels. They're attempting to source from Swiss refiners, American refiners, and Australian refiners. But those refiners are already running at capacity servicing their existing customers. They don't have spare capacity to absorb demand that was previously filled by China. This uncertainty in export flows helps explain why the Shanghai premium has widened significantly. In January 2025, silver in Shanghai traded at approximately $2 to $3 over the COMEX price, enough to cover shipping and insurance. By mid-year, the premium had widened to $6 to $8. By late December, traders were reporting premiums in the $15 to $20 range, though these figures can vary day to day and are based on wholesale market transactions that aren't always transparent. If physical silver in China is indeed trading $15 to $20 per ounce higher than the paper price in New York, this represents more than just shipping costs. It suggests a meaningful disconnect in market connectivity, indicating that physical silver is becoming harder to move from east to west due to the new licensing framework. It means silver is trapped in China while Western buyers are starving for supply. And then there's the London Bullion Market Association rule change. On January 1st, the LBMA implemented updated good delivery standards. Any silver bars with non-Roman alphabet lettering or hallmarks linked to sanctioned jurisdictions lost their good delivery status for trading purposes. A significant quantity of silver currently in Western vaults was produced by Russian and Central Asian refiners before the 2022 sanctions. These bars have Cyrillic serial numbers, Russian hallmarks, or Kazakh refiner stamps. The silver itself meets purity specifications at 0.999 fine. However, under the updated rules, these bars cannot be used to settle futures contracts on the LBMA or COMEX. They're classified as non-deliverable for exchange purposes. The bars can be remelted and recast with acceptable markings. This process is happening, but refining capacity is limited, and facilities are already processing newly mined ore. Industry estimates suggest working through the backlog could take 12 to 18 months. During this period, that silver remains in vaults, but cannot be used for contract settlement. Industry sources estimate that 200 to 300 million ounces may be affected by this classification change. That's silver that physically exists in vaults, but is temporarily unusable for exchange delivery purposes while it awaits reprocessing. That's more than 10 times the entire COMEX registered inventory. It's silver that exists, that's physically in vaults, but that's legally unusable for settlement purposes. The effective supply dropped by 300 million ounces overnight. So let's add it up. Mine production can't scale quickly. Industrial demand is inelastic and growing. Above-ground inventory is being drawn down at 120 million ounces per year. China restricted exports, cutting off 60% of refining capacity. The LBMA froze 300 million ounces with a rule change, and COMEX registered inventory dropped from 32 million ounces to 19 million. During the year, prices tripled. This is why silver went up 169%. This is why it outperformed gold by nearly 100%. This is why JP Morgan positioned ahead of it. And this is why it's not over. Because here's what most people don't understand. The supply crisis didn't get solved by higher prices. It got worse. At $78 per ounce, you'd expect industrial users to slow down, to conserve, to look for substitutes, to wait for prices to come back down. But they didn't. They kept buying. Solar installations in 2025 actually accelerated compared to 2024. Electric vehicle production increased. Smartphone sales grew. The industrial demand that drove the deficit in the first place? It's still there, still growing. And the supply response everyone expected? It didn't materialize. No new silver mines broke ground in 2025. Existing mines increased production marginally. Recycling increased slightly, but nowhere near enough to offset the deficit. The 120 million ounce annual supply gap is still there, which means inventory will continue to decline in 2026. COMEX registered will continue dropping. At some point, probably within the next 6 months, it reaches zero. What happens then? Let's walk through the mechanics. COMEX silver futures are contracts that give the buyer the right to take delivery of 5,000 ounces of physical silver. Most contracts are closed before expiration. Traders don't want the metal. They're speculating on price movements. Historically, only 1 to 3% of contracts stand for delivery. The system was designed around that assumption. But when industrial users can't source silver anywhere else, they start standing for delivery on COMEX contracts. They use the futures market as a last resort to secure physical supply. As delivery requests increase, COMEX has to release metal from registered inventory to fulfill those contracts. If registered inventory is 19 million ounces and delivery requests total 25 million ounces, the exchange can't deliver. The vault goes negative. They don't have the metal. At that point, COMEX has a few options. They can halt trading and declare force majeure, which is a legal provision that allows them to suspend physical delivery and settle contracts in cash due to unforeseen circumstances. They can restrict new contracts to cash settlement only, meaning no physical delivery allowed going forward. None of these options are good. If COMEX declares force majeure and forces cash settlement, what happens to the people holding contracts? They bought silver at $30 expecting to take delivery of physical metal. The spot price ran to $78, then $90, then $100. They're sitting on massive paper profits. But instead of getting physical silver, they get a cash payment based on whatever settlement price the exchange determines. That settlement price might be well below the market price because the exchange is trying to minimize its liability. This is the scenario JP Morgan prepared for when they moved to Singapore. They're holding 750 million ounces of physical metal in vaults beyond COMEX jurisdiction. If COMEX declares force majeure, if the paper market breaks down, JP Morgan's metal is untouchable. They can sell it for whatever price they want to whoever they want. They're not subject to forced cash settlement. They own the metal outright. And this is the critical point that everyone needs to understand. There's a huge difference between owning a claim on silver and owning physical silver. If you own shares of SLV, the largest silver ETF, you own a claim on a trust that's supposed to hold silver. If that trust faces a liquidity crisis, if they can't source silver to back the shares, If they go bankrupt, you're an unsecured creditor. You might get cash, you might get pennies on the dollar. The prospectus explicitly states that the trust may settle in cash if physical delivery is impractical. If you own an unallocated silver account at a bank, you own a claim on the bank's silver holdings. But you don't own specific bars. You own a share of a pool. If the bank faces a silver shortage, if they're fractionally reserved and don't actually have enough silver to back all the claims, you're competing with other creditors for whatever metal exists. Physical silver in your possession is different. It's yours. It can't be rehypothecated. It can't be lent out. It can't be used to settle someone else's obligations. If the paper market breaks down, if COMEX declares force majeure, if ETFs suspend redemptions, if banks freeze accounts, your physical silver is unaffected. You can sell it for whatever price the physical market is actually paying, which might be vastly higher than the paper price. This is the lesson from the nickel crisis in 2022. When nickel prices exploded on the London Metal Exchange, and a major trader couldn't cover his short position, the exchange didn't let the market function. They halted trading. They canceled billions of dollars worth of trades. They rewrote the rules to save the institutions that were underwater. The people who had made legitimate profits in a functioning market had those profits erased to bail out someone who bet wrong. Silver is setting up for the same thing. The paper market is over-leveraged. COMEX has 19 million ounces of registered inventory backing contracts that represent 750 million ounces of claims. That's a leverage ratio of 40-1. The system only works if almost nobody asks for delivery. But industrial users are asking. Demand for physical is increasing. Delivery requests are accelerating. And there's no mechanism to create more inventory quickly. November 2025, COMEX delivered 4 million ounces against expiring contracts. December, 5.5 million ounces. If January sees 7 million ounces delivered, registered inventory drops to 12 million. If February sees another 7 million, it drops to 5 million. At this rate, the vault is empty by May or June. And we're not even talking about a surge in delivery requests, just a continuation of the current trend. The people watching this data, the people tracking inventory reports every week, the people monitoring delivery statistics, they see what's coming. This is why premiums on physical products exploded in 2025. A Silver Eagle coin that sold for $3 over spot in January was selling for $18 over spot in December. That's not minting costs. That's not shipping delays. That's the market pricing and the risk that paper and physical are diverging. The premium is the market's way of saying the real price of silver is spot plus 18, not spot alone. Generic rounds went from $1.50 premium to $12. Bars went from 50 cents to $8. These premiums widened throughout the year, even as spot prices were going up. In a normal market, higher spot prices would compress premiums because supply would increase. But supply didn't increase. Dealers couldn't restock easily. The mints were rationing production. Delivery times extended from 2 weeks to 6 weeks to 12 weeks. The physical market was tightening while spot prices were rising. That's the signature of a supply crisis, not a speculative bubble. Now we're in January 2026. China's export restrictions have been live for 4 weeks. The LBMA rule change took effect 4 weeks ago. Industrial users are entering the new year with the same demand they had in 2025. Probably higher, because EV production is ramping and solar installations are accelerating. Supply is more constrained than it was 12 months ago, and COMEX inventory is 40% lower than it was when the year started. This is Phase 3. Phase 1 was January through August 2025. That was the stealth accumulation phase. The smart money, led by J.P. Morgan, was building positions while silver traded between $29 and $40. The data was screaming that a shortage was coming, but almost nobody was paying attention. The people who positioned in Phase 1 made 100 to 150% returns. That window closed when silver broke above 45 in September. Phase 2 was September through December 2025. That was the breakout phase. Spot went from 45 to 78. The gold-silver ratio collapsed from 75 to 58. COMEX inventory cratered. Shanghai premium exploded. Industrial users started panicking quietly. The people who bought in Phase 2 made 40 to 70%. Phase 3 is now. January 2026 forward. This is the crisis phase. This is where the structural imbalances become undeniable. This is where the paper market breaks down. This is where force majeure becomes a real possibility. This is where physical and paper prices separate permanently. Let's talk about what to actually watch in the coming months. I'm going to be tracking these data points every single week and reporting them to you. So make sure you're subscribed so you don't miss the updates. First, COMEX registered inventory. This number is published every week. If it drops below 15 million ounces, the risk of force majeure becomes acute. If it drops below 10 million, force majeure is almost certain within months. Track this number religiously. Second, the Shanghai premium. If it widens from $20 to $30 to $40, that's telling you the physical supply crisis is intensifying. China's export restrictions are biting harder. Western buyers are getting more desperate. The bifurcation between Asian physical and Western paper is becoming more extreme. Third, dealer premiums and delivery times. Here's what you can do right now. Call APMX, SD Bullion, and JM Bullion. Ask about delivery times for bars and coins. Write down what they tell you. Then call again in 2 weeks and compare. If they tell you 12 weeks instead of 6, supply chains are deteriorating. If premiums on Silver Eagles go from $18 to $25 to $35, the physical market is in panic mode. Fourth, industrial user statements. Watch earnings calls from public companies. Read SEC filings. If a solar manufacturer mentions silver supply constraints, if Tesla says they're having trouble sourcing battery materials, if a defense contractor flags silver as a bottleneck, that's confirmation the shortage has moved from financial markets into the real economy. That's Phase 3 accelerating. Fifth, ETF inventory changes. SLV and PSLV publish daily holdings. If SLV inventory starts dropping sharply, it means they're bleeding metal to meet redemptions. It means holders are pulling physical out because they don't trust paper. If PSLV inventory is growing while SLV is shrinking, it's because sophisticated investors know PSLV is fully allocated and segregated, while SLV is not. Sixth, the gold-silver ratio. If it drops from 58 to 50 to 45, silver is continuing to outperform and compress the valuation gap. Historical parallels suggest it could go to 30 or lower. At 30 to 1 with gold at $4,500, silver would be $150. That's not a forecast. That's math based on historical ratio compression during previous silver bull markets. Let me give you 3 concrete scenarios for where this could go based on the data. Scenario 1. Managed decline. COMEX slowly bleeds inventory over 12 months instead of 6. They get creative with incentives to bring eligible inventory into registered status. China eases export restrictions slightly. The crisis unfolds slowly. In this scenario, silver reaches $100 to $120 by end of 2026. The gold-silver ratio compresses to 45 to 1, and the physical market remains tight but functional. This is the best-case scenario for the system. Scenario 2. Controlled break. COMEX registered inventory drops below 10 million ounces by April or May. The exchange declares force majeure, but manages it relatively smoothly. Paper contracts get cash settled at spot price plus a premium. Physical silver trades at a $30 to $50 premium over paper for 6 to 12 months while the market rebalances. Silver hits $150 to $200. Gold-silver ratio compresses to 35 to 1. This is the most likely scenario based on current trajectory. Scenario 3. Systemic failure. Multiple exchanges declare force majeure simultaneously. China completely restricts exports. Industrial users compete desperately for physical. The Shanghai premium explodes to $75 to $100. Western physical markets lock up entirely. Silver spikes to $300 or higher. The gold-silver ratio crashes to 20 to 1 or lower. This is the tail risk scenario. Low probability, but catastrophic impact if it happens. I'll be analyzing which scenario we're tracking toward in every update. The key leading indicator is COMEX inventory. If we're losing 7 million ounces per month, we're on track for scenario 2 by spring. If it accelerates to 10 million per month, scenario 3 becomes probable. But here's what you can't do. You can't wait for mainstream media confirmation before you act. By the time CNBC is running special reports on the silver shortage, by the time Bloomberg is featuring it on the front page, by the time financial advisors are recommending it to clients, the physical market will be locked up. Dealers will be sold out. Premiums will be $50 to $80 over spot. The U.S. Mint will have year-long waiting lists. You'll be competing with millions of people who suddenly want physical silver, and there won't be any available. The shortage is real. The data proves it. COMEX inventory is dropping. Shanghai premium is widening. Industrial demand is inelastic. New supply can't come online for years. The paper market is over-leveraged and heading for a breaking point. All of this is observable right now. You don't need to trust anyone's opinion. You can verify every data point yourself. J.P. Morgan figured this out in early 2025 when silver was $29. They didn't wait for confirmation. They didn't wait for mainstream coverage. They read the industrial order flow. They analyzed the inventory data, and they positioned. Now they're sitting on a $36 billion profit, and they're positioned in Singapore with physical metal beyond the reach of exchanges that are going to fail. You can't replicate their position. You're not going to accumulate 750 million ounces. But you can learn from their playbook. They positioned ahead of the crowd. They focused on physical, not paper. They moved their assets beyond the jurisdiction of failing systems. The scale is different, but the principles are the same. The question isn't whether silver at $78 is expensive. The question is what happens when COMEX registered inventory hits zero. What happens when industrial users can't source supply at any price? What happens when the paper market declares force majeure and everyone holding contracts realizes their claims aren't backed by metal? That's the Phase 3 scenario. That's where we're heading over the next 6 months. And once we're there, once the system breaks, the only thing that matters is whether you're holding physical metal or paper claims. Because the people holding paper are going to get cash settled at prices determined by failing exchanges. And the people holding physical are going to be able to sell into a market where industrial users are desperate and price is no object. This is the biggest commodity move since oil in the 1970s. It already happened. 169% in 1 year. Bigger returns than artificial intelligence stocks. Bigger returns than the best performing cryptocurrencies. And most people completely missed it because financial media didn't cover it and they weren't tracking the right data. But the move isn't over. The supply deficit that caused it hasn't been solved. It's gotten worse. COMEX inventory keeps dropping. Industrial demand keeps growing. China's export controls just started. The LBMA rule change just took effect. New mine production won't come online until the 2030s. We're in the middle of a structural crisis that will take years to resolve. Phase 3 is starting now. This is the crisis phase. This is where systems break. This is where paper and physical diverge permanently. This is where the people who understand what's happening separate from the people who are still waiting for permission from CNBC. This is the greatest wealth transfer in commodity markets since the 1970s oil crisis. It's already in motion. 169% moves don't happen in stable, well-supplied markets. They happen when structural imbalances reach breaking points, when above-ground inventory runs out, when paper claims exceed physical availability by 40 to 1, when industrial users compete desperately for supplies that don't exist. That's where we are. That's what the $78 price is telling you. It's not the end of the move, it's the middle. Subscribe to this channel right now, because over the next 6 months, we're going to watch this unfold in real time. Every week, I'll be posting updates on COMEX inventory, Shanghai premiums, dealer availability, and which of the 3 scenarios we're tracking toward. When the physical market locks up, when force majeure gets declared, when paper and physical diverge by $50 to $100, you're not going to find this analysis anywhere else. The mainstream media won't cover it until it's too late. But if you're subscribed here, you'll see it coming weeks in advance. Hit that subscribe button, turn on notifications, because Phase 3 is going to move fast. When COMEX inventory drops below 15 million ounces, you'll have maybe 4 to 8 weeks before the crisis goes critical. That's your window. And I'll be tracking every data point so you know exactly when we cross that threshold. This is just the beginning. 169% in 2025 was Phase 2. Phase 3 starts now. And the people who positioned themselves in physical silver before the paper market breaks are going to be the ones who profit from the greatest supply squeeze in modern history. I'll see you in the next update.